I'm Mary Ellen Stanek, President of Baird Funds and Chief Investment Officer of Baird Advisors. And joining me today from our taxable team, Jeff Schramm, Meg Dean, and Abhi Polankanti. Now, when we think about 2020, it was a year like none other that we've lived through and managed our investors' assets through. Just talk about the key things that we tried to do and particularly where we saw value.
Yeah, what we saw last year was an unprecedented amount of volatility in the markets, and then what we saw in the end of first quarter was a record amount of new issuance where high quality companies were coming to the markets with a very good spread concession. We took advantage of the markets opportunity that presented to the portfolios. On the same side, we are balancing our clients' liquidity needs and also seeing what the market is offering from the portfolios.
So quality was on sale, and we took advantage of that while we still protected the liquidity in the portfolios should our clients, our investors need that liquidity.
Correct.
Meg, when we think about portfolio construction overall, certainly the mortgage-backed, both residential mortgage and commercial mortgage-backed securities, as well as the asset-backed security side of the portfolio is important. Can you talk about that part of the portfolio and the positioning?
Billy, when we look at March of 2020 and we think about quality being on sale, it actually was the worst performing month in the history of the asset-backed security market. And really where that was most expressed was in high quality ABS, really sectors where Baird Advisors has historically been most active, and primarily credit cards and auto receivables. As many market participants looked to these high quality sectors to meet those redemptions. So during those periods of March when the ABS market was shut down for a month, we added to that portion of the portfolio. And actually during those early weeks, we took up the agency mortgage exposure in the portfolio 2% in 2 days. And really it was a collaboration with our credit team and our leadership team that allowed us to do that in the days leading up to the Fed's eventual announcement of open-ended quantitative easing.
So you took advantage of the volatility across the board. Now as we look back in the rearview mirror, on a risk-adjusted basis, really strong performance, net of the expense ratios. In fact, you could argue one of our best, if not our best added value year ever. But as you look now to 2021, maybe talk a little bit more about what you're seeing right now and how you're positioning the portfolios.
On the credit side specifically, right now, spreads have come in a lot from the wides that we saw in March through June, and as a result, our credit overweight has come down. So as we see that we're getting compensated less for the risk that we would take, we've let the overweight come down. We still see some opportunities out there. There's good value in triple Bs. There's good value in financial intermediaries that are very much aligned with the interests of bondholders because they need to continually access the market. So there's some key long-term tenets to the strategy that we continue to have in place, but the overweight to credit has come down, and if we continue to see more tightening, it'll probably come down a little bit more.
So Abhi, where on the yield curve we own the credit in particular names? Now maybe talk about that, how we integrate those decisions into the credit,
Sure.
Really the total portfolio strategy, but the credit strategy, and particularly how we want to capitalize on
Sure.
roll down.
One of the long-term tilts in the portfolio is we take our credit exposure shorter than the benchmark, as we believe generally we are not compensated to go long credit, as the credit curves are generally not compensating for us to extend. Saying that, so we still find good value in the intermediate part of the curve, like around 6 to 7 year part of the curve, like there's a good roll down opportunity in this environment where the overall spreads are very low. Doing like a small things in the portfolio can add value over time.
Yeah, so the microsurgery of what we
Yeah.
do, and roll down, of course, is, bond managers, we love roll down because with the passage of time, you're rolling down a steep yield curve to lower yielding higher price points, and it turbocharges your total return.
Exactly.
So Meg, talk about our positioning right now on the structured side of the portfolio.
Where we see opportunity is in very high quality consumer sectors. To your question earlier about commercial mortgage-backed securities, again, all AAA index eligible conduit CMBS. We've seen a lot in the headlines as it relates to single asset, single borrower, and the rise in commercial real estate floating rate loans. We're not active in those sectors. We like index eligibility, we like liquidity, and actually issuance remains actually somewhat subdued in that sector as really there's very limited transactions. So we like seasoned collateral where we've seen those securities or those underlying loans actually appreciate in value.
So thanks for your leadership. All of you play important roles certainly to the overall portfolio structure on a day in and day out basis, but also the leadership you provide for the entire team. It was a year when we look back like none other, but when you look at the year of growth, particularly for all of us, but including our younger talent on the team, they had an outsized years of growth and development, and that was because they were able to manage through all the weather. We talk about our all-weather strategies with very experienced team members like the three of you. So thank you for that. Plenty of weather in the rearview mirror, different kind of weather as we face 2021, but we're optimistic in terms of the portfolio structure. Thanks for joining me today.